Welcome, everyone. Today we are diving into something that could make a huge difference in your trading journey. We are going to learn how to read and use the fixed range volume profile. Now, this is a tool that helps traders understand what is happening in the market in terms of trading volume within a specific time period or price range. By the end of this session, you will be able to set up, read, and use this tool to spot key price levels. It will help you make smarter and more informed trading decisions. Let us jump right in. Imagine being able to pinpoint exactly where the market's biggest moves are happening. Imagine having a tool that lets you zoom in on the most crucial moments and spot key price levels with precision. To start off, let us go over the basics. What exactly is the fixed range volume profile? The fixed range volume profile shows how much trading volume took place at different price levels within a specific time range that you select. This tool is helpful when you want to focus on specific market events or trading sessions. Unlike the standard volume profile that covers the entire chart, this tool allows you to zoom in on a particular area, giving you more detailed insights for that period. You can also use the fixed range volume profile to spot well-known chart patterns. These include double tops, double bottoms, head and shoulders, wedges, triangles, and flags. For instance, when the price returns to a high volume level and forms a double top, it could mean strong resistance. Double bottoms at high volume areas often act as reliable support. A head and shoulders pattern forming around key volume levels can confirm a possible reversal. Wedge patterns, which can be rising or falling, often show a potential breakout when they align with areas of low trading volume. This low activity usually means a bigger move could be on the way. Triangles, whether ascending or descending, form when price action moves into a tighter range. These patterns tend to break out with strength, and looking at volume can help confirm if the breakout is likely to succeed. Flags form after a sharp price movement, followed by some sideways action. You can spot these patterns more easily when you combine them with the fixed range volume profile, as volume often decreases during consolidation and then spikes when a breakout happens. By using these chart patterns along with the fixed range volume profile, you can identify key price levels and confirm them with recognizable patterns. This combination makes trade signals more reliable. Understanding how volume behaves while these patterns form gives you an advantage in predicting market moves and taking the right positions. Setting up the fixed range volume profile is quite simple, so let us walk through it step by step. First, open your trading platform and navigate to the Indicators menu. From there, select the fixed range volume profile. Once you have selected the indicator, you need to define your range by picking your start and end points on the chart. This could be based on any specific time period you want to analyze, such as a particular trading day or a key market event that you believe is significant. When you have set your desired range, the profile will automatically display the volume bars along the price axis. These bars represent the trading volume at each price level within the selected range, giving you a visual representation of where the most activity occurred. You also have the flexibility to customize various settings to match your trading approach. For instance, you can adjust the look-back period to focus on specific historical data, or you can change the number of price levels shown in the profile for greater or lesser detail. Additionally, you can modify the time frame to suit your strategy, whether that means focusing on short-term intraday movements or longer-term price trends. The key is to align the range you choose with the specific market event or time period you are interested in studying. For example, if you are examining a major price spike that occurred due to news, you might want to focus solely on that event to understand where the most volume was traded during that time. On the other hand, if you are looking at a broader trend, you might want to expand your range to encompass several weeks or months of trading data. This flexibility makes the fixed range volume profile an invaluable tool for zooming in on market behavior and gaining precise insights that fit your trading goals. All right, now that we have the profile set up, let us talk about the important components of the fixed range volume profile. First, there is the point of control. The point of control, or POC, is the price level in your selected range where the highest volume of trades took place. Think of it as the level where everyone is paying the most attention. Often, it can act as a key support or resistance level. Next, we have the value area. The value area is the range of prices where about 70% of the volume occurred. This area is crucial because it shows where most of the trading activity took place, which many traders consider to be the fair market value. Within this value area, we also have two important levels, the value area high and the value area low. The value area high is the upper boundary, and the value area low is the lower boundary of this zone. When the price moves above the value area high, it can signal a potential breakout to the upside. Conversely, if the price drops below the value area low, it can indicate a potential downward breakout. These boundaries are often watched closely by traders to determine potential shifts in market direction. It is also important to understand how chart patterns interact with these components. For example, a double top forming around the point of control can indicate strong resistance, especially if trading volume supports this. A double bottom forming near the value area low can signify strong support. The head and shoulders pattern is another key chart pattern to watch for, especially when it aligns with the point of control or the value area boundaries. If a head and shoulders pattern forms around the value area high, it can suggest a potential reversal from an uptrend. On the other hand, an inverse head and shoulders pattern near the value area low can point to a possible reversal from a downtrend. Wedge patterns are another type of formation that you can use with the fixed range volume profile. Rising wedges that form near the value area high may indicate a bearish breakout, while falling wedges near the value area low can suggest a bullish breakout. Understanding where these patterns form relative to high volume and low volume areas helps you gauge the strength and likelihood of the breakout. Finally, triangles and flags are also valuable to look for. Ascending triangles near the value area high can show a potential continuation of the uptrend if volume supports a breakout. Flags, which often form after strong price movements, can indicate periods of consolidation. If a flag forms near the point of control, it suggests that traders are finding consensus at that price level before the next move. Watching how volume changes during these formations gives clues about when the consolidation might end and which direction the price is likely to go. Keep all these interactions in mind as we move on, as they can help you make better trading decisions by understanding not just the price action, but also the volume dynamics behind it. Let us talk about how you actually read the fixed range volume profile. It is easier than you might think. First, we have high volume nodes. These are price levels where a lot of trading activity happened. They create strong support or resistance zones because many traders have established positions there. Then there are low volume nodes. These are price levels with very little trading activity. When the price moves through these levels, it tends to move fast. This makes low volume nodes interesting areas to watch for potential breakouts. Now that you know the basics of how to read the profile, let us discuss how you can use it to spot support and resistance. If the price is dropping and it hits a high volume node, it often acts as support. Traders tend to step in, and the price either pauses or even reverses. On the other hand, if the price is rising and approaches a high volume node, it can act as resistance. Sellers often step in, which causes the price to reverse or stay in place for a while. Okay, now for the fun part, trading strategies. I am going to share a few detailed strategies you can use with the fixed range volume profile. The first one is trading using the point of control. The point of control, or POC, is where the most trading volume took place, making it a key price level. When the price approaches the POC from below during an uptrend, it can signal an opportunity to go long. This is because the POC represents a fair value area that buyers and sellers have previously agreed upon, and price often bounces off this level. In a downtrend, if the price approaches the POC from above, it might be a good opportunity to go short, as the price could reverse due to high selling interest. Another strategy involves breakout trading using low volume nodes. Low volume nodes represent price levels with little trading activity, which often leads to fast price movement when these levels are breached. These areas are like gaps in trader interest, and because of this, price tends to move quickly through them since there is less friction or resistance to slow it down. If the price breaks through either the value area high VH or the value area low VL and moves into a low volume area, it could present a breakout opportunity. For example, if the price breaks above the VH and moves through a low volume area, it can indicate strong upward momentum with little resistance, meaning the price can rise rapidly until it hits the next level of interest or volume. Traders often look for confirmation from rising volume when the price enters these zones, as this signals strong participation in the breakout. Similarly, if the price drops below the VL into a low volume area, it could indicate strong downward momentum. Again, if volume starts to increase as the price moves through the low volume area, it adds to the confidence that the move is strong and likely to continue. Low volume nodes can therefore act as accelerators for price movements, and identifying them provides a good opportunity to capitalize on rapid trends. Trend reversals are another effective strategy with the fixed range volume profile. If the price hits either the POC or one of the value area boundaries VH or VL and begins to reverse with increasing volume, this is a strong signal of a potential trend reversal. For instance, if the price moves up to the VH and fails to break through, while volume starts to increase, it could mean that sellers are taking control, indicating a possible reversal to the downside. Conversely, if the price falls to the VL and starts to bounce with increased buying volume, it may suggest that buyers are stepping in, leading to a reversal to the upside. Another key chart pattern to look out for is the consolidation breakout. Often, the price will consolidate in a narrow range near the POC, where buyers and sellers are in balance. When this consolidation ends and the price breaks out on increased volume, it can be a powerful trading opportunity. The breakout direction gives a clear signal of market sentiment, and volume helps confirm whether the move is likely to continue. Also, consider pullback trading opportunities. If the price breaks out from a high volume area and moves quickly into a low volume zone, a pullback to retest the breakout level is often a good entry point. Traders can use the POC or the VH/VL as reference levels for placing their trades and managing their risk. By understanding these strategies in depth and recognizing how they relate to key levels like the POC, VA, and VAL, you can make better informed trading decisions. Always pay attention to how the price behaves around these volume levels and look for confirming signals like volume increases or decreases to validate your trades. It gets even better when you combine the fixed range volume profile with other tools, especially when you understand how these tools interact with common chart patterns. For example, moving averages can help confirm which way the trend is going, and they work particularly well when used alongside patterns like double tops, double bottoms, or head and shoulders. If the price is above a moving average and near the value area high, that strengthens the case for a breakout, especially if it aligns with an ascending triangle pattern that suggests continued upward momentum. Another great tool is the Relative Strength Index, or RSI. This tool helps to show whether the market is overbought or oversold. When combined with chart patterns, RSI can add an extra layer of confirmation. For instance, if the RSI shows overbought conditions while the price is forming a double top near a high volume node, it adds weight to the possibility of a reversal. Similarly, if RSI indicates oversold conditions and the price forms a double bottom at the value area low, it strengthens the signal for a potential bullish reversal. Fibonacci retracement levels are another powerful tool to use with the fixed range volume profile. These retracement levels often align with key volume levels and chart patterns. If both the Fibonacci level and a chart pattern, like a wedge or a flag, align at a specific price level, it makes that level an even stronger area to watch for support or resistance. For example, a rising wedge that ends near a key Fibonacci retracement level and a low volume node could indicate an impending bearish breakout. By combining these tools, moving averages, RSI, Fibonacci retracements, with chart patterns and volume profile analysis, you gain a comprehensive view of the market. This multi-layered approach allows you to confirm setups more effectively, leading to higher probability trading opportunities and more informed decisions. Let us switch gears and talk about risk management. This is a crucial part of successful trading. You can use the fixed range volume profile to help determine the best spots to place your stop losses. One effective rule is to place your stop losses just outside key volume levels like the value area high or the value area low. If the price breaks beyond these levels on strong volume, it may continue moving in that direction, so you need to be cautious. Another key aspect of risk management is adjusting your position size based on the trading environment. When trading through low volume nodes, consider using smaller position sizes because the price tends to move quickly in these areas, which means higher volatility and greater risk. On the other hand, when trading near high volume nodes, you can opt for larger positions, as these levels typically provide stronger support or resistance. By managing your position sizes and stops with respect to the volume levels, you can reduce potential losses and optimize your risk-reward ratio. Let us make sure you are aware of some common mistakes people make with the fixed range volume profile. The first mistake is focusing only on high volume nodes. Yes, these areas are important because they indicate strong support or resistance, but do not ignore the low volume nodes. Low volume nodes can often lead to quick price movements since there is less activity and less interest at these levels. This means that when the price enters a low volume zone, it can move quickly, making these areas crucial for identifying potential fast breakouts or breakdowns. The second mistake is not adjusting for the right time frame. Different traders use different time frames depending on their strategy. If you are a day trader, you want to use shorter time frames, such as hourly or even minute-by-minute profiles, to capture quick market movements and intraday trends. These shorter profiles help in identifying quick shifts in volume and price action that can be capitalized on within the day. For swing traders and position traders, using longer time frames such as daily, weekly, or even monthly profiles is more appropriate. These profiles help provide an overview of broader market trends and significant support and resistance areas that develop over time. For example, a swing trader might look at a weekly volume profile to identify key levels that could impact trades over several days, while a position trader might use a monthly profile to establish long-term entry and exit points. Always make sure that the time frame you are analyzing matches your trading strategy, as this will provide the most relevant information for your trades. Analyzing the wrong time frame can lead to misleading signals. For example, using a daily volume profile for a quick day trade might cause you to miss crucial short-term volume changes, while using a minute-by-minute profile for a long-term trade might result in unnecessary noise and confusion. Ensuring your time frame is aligned with your strategy is essential for making informed and effective trading decisions. Another common mistake is not recognizing the importance of chart patterns within the volume profile. For example, traders sometimes overlook how patterns like double tops, double bottoms, and head and shoulders interact with the volume profile. These patterns often align with key volume areas and can provide stronger signals when combined with volume analysis. For instance, a double top forming at a high volume node may indicate a more reliable resistance level, while a double bottom at a low volume area could signal a rapid move upward once broken. Lastly, avoid using the volume profile in isolation. It is essential to combine the fixed range volume profile with other tools like moving averages, the relative strength index RSI, or even Fibonacci retracement levels. You can also incorporate chart patterns like double tops, double bottoms, and head and shoulders to strengthen your analysis. Using these tools together helps to confirm trade setups and provides a more complete picture of market conditions. For instance, moving averages can provide insight into the direction of the overall trend. If the price is above a key moving average and near the value area high, this may indicate a potential continuation of the uptrend, especially if it coincides with an ascending triangle chart pattern. The relative strength index RSI is another useful tool for gauging market conditions. For example, if the price is near a high volume area and the RSI is showing overbought conditions, it strengthens the likelihood of a reversal. Similarly, if RSI shows oversold conditions while the price is forming a double bottom near the value area low, it adds weight to the bullish reversal scenario. Fibonacci retracement levels are also powerful when used alongside chart patterns and volume profiles. When a key Fibonacci level aligns with the value area or the point of control, and you see a pattern like a wedge or flag forming, this provides a very strong level of confluence. For example, a falling wedge near the point of control and a Fibonacci retracement level can suggest a high probability reversal to the upside. By combining multiple indicators such as moving averages, RSI, Fibonacci retracements, and chart patterns like double tops, head and shoulders, or wedges, you increase the chances of identifying high-quality trading setups. Each tool adds a layer of confirmation, making your trading decisions more reliable and giving you a clearer understanding of potential market movements. So let us quickly recap. The fixed range volume profile is a powerful tool that helps you understand the volume traded at each price level during a specific time range. It helps you find areas of support, resistance, and potential breakouts. You can start by selecting key market events or time periods to focus on. Then pay attention to high volume nodes for support and resistance and low volume nodes for breakouts. The fixed range volume profile is a fantastic tool that can really improve your trading accuracy. It takes some time and practice to master, but once you do, it will help you spot high probability trading opportunities. Remember to keep refining your skills and combine what you learn with other tools. If you have questions or ideas to share, feel free to dive into the discussion. We are all here to learn and improve together, so let us keep the conversation going and help each other grow.